Topic for this video is Module 4, Investment Instruments, Chapter 11, Derivatives, for the CFA Institute Investment Foundations program. So here we are in Module 4, Investment Instruments. The topic for this video today is Chapter 11, Derivatives. There are 7 learning outcome statements, and as you can see, there's only 42 questions in the learning ecosystem. This is a nice, light, introductory chapter to derivatives, not too difficult, not too complex at all. The learning outcome statements for this chapter are learning outcome statement A, define a derivative contract. B, describe uses of derivative contracts. C, describe key terms of derivative contracts. D, describe forwards and futures. E, distinguish between forwards and futures. F, describe options and their uses. And finally, G, define swaps and their uses. Learning outcome statement A is define a derivative contract. So you can see this topic in this chapter is dealing with forwards, futures, options, and swaps. So just going to give the definition. Forward contract is an over-the-counter derivative contract in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date at a fixed price they agree upon when the contract is signed. Okay, no money is exchanged hands when the contract is signed. A futures contract is a standardized derivative contract created and traded on a futures exchange in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date at a price agreed upon by the two parties when the contract is initiated. So you can see that's very similar to a forward contract. Later on, we're going to see there's the similarities and differences between forwards and futures, but you can see from that sentence, very similar to a forward contract. The buyer will purchase an underlying asset from the other party, the seller, at a later date at a price agreed upon by the two parties when the contract is initiated. That's basically the same, okay? However, there's a daily settling of gains and losses and a credit guarantee by the futures exchange through its clearinghouse. Options give the one party, the buyer, to the contract the right to extract an action from the other party, the seller, in the future, okay? In an option contract, the buyer of the option has the right, but not the obligation, to buy or sell the underlying. Finally, a swap contract is an over-the-counter derivative contract in which two parties agree to exchange a series of cash flows whereby one party pays a variable series that will be determined by an underlying asset or rate, and the other party pays either 1, a variable series determined by a different underlying asset or rate, or 2, a fixed series. So continuing with the introduction, derivatives are contracts that derive their value from the performance of an underlying asset, event, or outcome, hence their name, derivatives. Since the development of derivative contracts to help reduce risk for farmers, the uses and types of derivative contracts and the size of the derivatives market have increased significantly. Derivatives are no longer just about reducing risk, but form part of the investment strategies of many fund managers. Derivatives can be created on any asset, event, or outcome, which is referred to as the underlying. The underlying can be a real asset, such as wheat or gold, or a financial asset, such as the share of a company. The underlying can also be a broad market index, such as the S&P 500 index or the FTSE 100 index. And the underlying can also be an outcome, such as a daily temperature under or over a specified temperature, also known as heating and cooling days, or an event, such as a bankruptcy. Learning outcome statement B is describe uses of derivative contracts. So in this slide, we're looking at the use of a derivative contract to provide a hedge. And a hedge is an action that reduces uncertainty or risk, okay? So in this example, a farmer anticipates having at least 50,000 bushels of wheat for sale in 6 months. Wheat is currently trading in the market at $9 per bushel. That's the spot price. The spot price is the current price. The farmer finds a cereal producer that needs wheat and is willing to contract to buy 50,000 bushels of wheat at a price of $8.50 per bushel in 6 months. So the contract provides a hedge for both the farmer and the cereal producer. The farmer knows exactly what their income will be in 6 months. It'll be $50,000 times $8.50, and the cereal producer will know with certainty what their expense will be for those 50,000 bushels of wheat. Derivatives are not only used for hedging, but also for speculation. So it's saying, what if the farmer cannot find someone who actually needs the wheat? Well, the farmers might still find a counterparty that is willing to enter into a contract to buy the wheat in the future at agreed upon price. This counterparty may be called a speculator. The counterparty is not hedging risk, but is instead taking on risk in anticipation of earning a return. Learning Outcome Statement C is describe key terms of derivative contracts. So we're looking here at some common characteristics among derivative contracts. You can see there's 4 main points here: underlying, size and price, expiration date, and settlement. Okay? So all derivatives are characterized by these certain common features. Starting with the underlying, derivatives are constructed based on an underlying which is specified in the contract. Originally, all derivatives were based only on tangible assets, but now some contracts are based on outcomes. A derivative's underlying must be clearly defined because quality can vary. In terms of size and price, the contract must also specify size and price. The size is the amount of the underlying to be exchanged. The price specified in the contract may be called the exercise price or the strike price. Okay, so again, some terminology to be aware of. Moving on to expiration date, all derivatives have a finite life. Each contract specifies a date on which the contract ends, called the expiration date. And finally, with regards to settlement, settlement describes how a contract is satisfied at expiration. This is very important. Some contracts require settlement by physical delivery of the underlying, and other contracts allow for or even require a cash settlement. If physical delivery to settle is possible, the contract will specify delivery locations. Contracts with underlying outcomes, such as heating and cooling days, cannot be settled through physical delivery and obviously must be settled in cash. So continuing with a little bit more information regarding the underlying, derivatives are based on, their value is based on an underlying, okay? So examples of underlyings include the following: agricultural products, including livestock, currencies, interest rates, individual shares and equity indices, bond indices, economic factors such as the inflation rate, natural resources such as crude oil, natural gas, gold, silver, and timber. That's where we often see futures contracts. Weather-related products such as heating and cooling days, or other products such as electricity or fertilizers. Learning Outcome Statement D is describe forwards and futures. Okay, so on this slide we're looking at forward contracts. So again, we're looking at this example of the farmer who has agreed to sell 50,000 bushels of wheat 6 months from today at $8.50 per bushel, and the cereal producer has agreed to buy that same 50,000 bushels of wheat 6 months from today at $8.50 per bushel. So a forward contract is for delivery in the future with set terms. It is traded in the over-the-counter market. That means it's a customized contract. It's not standardized. There is counterparty risk that the other side cannot deliver or pay because this is a contract between two parties. Okay? And finally, I put this in bold and green. There's no payment on when the contract is set. No payment on the contract is required by either party prior to the delivery. So the exchange of funds happens on the expiration date of the contract on a forward contract. Now we're moving on to futures contracts. And futures contracts are similar to forward contracts, but there's a couple of differences. Okay, number one, futures contracts are standardized contracts that trade on an exchange, and the exchange acts as an intermediary between buyers and sellers to reduce counterparty risk. The buyers and sellers do not necessarily know who is on the other side of the contract. Because the contracts are traded on exchanges, they are liquid, and it is possible for a buyer or seller to close out a position by taking the opposite side. In other words, the buyer of a contract can sell the same contract, and the seller of a contract can buy the same contract, and then the position has been closed out, okay? The presence of an exchange as an intermediary between buyers and sellers helps reduce counterparty risk. To protect itself against one of the parties defaulting, the exchange typically requires that parties to the contract deposit funds as collateral, which is called posting margin. So you can see for a futures contract, there is some movement of money when that contract is initiated because the exchange requires collateral, okay, which is called posting margin. The amount deposited on the day that the transaction occurs is called the initial margin, and the amount depends on the underlying price volatility. Marking to market means that profits or losses on futures contracts are settled at the end of every business day, which has the effect of resetting the contract price and cash flows to buyers and sellers, okay? That also reduces the counterparty risk because if the value of the contract is going up or down, marking to market means that profits or losses are settled at the end of every business day, okay? If at any time the balance in an account falls below a pre-specified amount, the exchange will ask the customer to submit additional funds. If the customer does not do so, the futures position is closed. So that helps to reduce the counterparty risk. Specifying the underlying in a futures contract includes defining the quality of the asset so that the buyer and seller have little room for confusion regarding price and physical delivery. So if we looked at futures contracts with regard to oil, there's many different qualities and grades of oil, so it has to be very specific. Certain deviations from the default quality standards are permitted with adjustments in price. So when we compare forwards and futures contract, we're going to look at the similarities. So the similarities, both types of contracts exist on a wide range of underlyings, including shares, bonds, agricultural products, and precious and industrial metals, amongst others. For both types of contracts, both the buyer and seller have obligations, and both types of contracts allow locking in a price today for a transaction that will occur in the future. Now we're moving on to looking at some of the differences between forwards and futures contracts, and there's 3 slides on this topic. So the first difference is trading and flexibility of terms. Forward contracts transact in the over-the-counter market, and they're customized according to the contracting party's needs. So forwards are customized agreements. Futures contracts trade on exchanges that typically set the standardized terms of the contracts. For hedgers that are trying to reduce or eliminate risk, standardization makes it difficult to precisely hedge a position. So that's the first thing. Forwards are customized, futures are standardized. In terms of liquidity, it is easier to exit a position prior to the settlement date with a futures contract than with a forward contract because they're standardized agreements that trade on exchanges. A position in a futures contract can be settled closed out by taking the opposite position in the same contract. And obviously you can't do that when there's a customized agreement in a forward agreement. Moving on to counterparty risk and the differences between forwards and futures contracts. Risk is high with forward contracts, but limited with futures contracts. Requirements imposed by exchanges, such as margins and daily marking to market, reduce the counterparty risk associated with futures contracts. Moving on to transaction costs, this is a key point. There can be significant costs to arrange a forward contract because they're customized agreements. Because futures contracts are standardized, transaction costs are relatively low. Also, there's more transparency in the futures market. Moving on to the differences between forwards and futures contracts with regards to the timing of cash flows. Forward contracts have no cash flow except at maturity. Futures contracts are marked to market daily. It is important to note that if forward and futures contracts with identical terms are held to maturity, the final outcome is the same. Okay? And finally, on settlement, forward contracts may settle with physical delivery or cash settlement, and futures contracts are typically settled with cash. So obviously, having gone through some of the similarities and differences between forwards and futures, obviously that can be well tested. Okay, so here's an example of a practice question from the learning ecosystem. It's classified at the difficult level. And here's the question. A contract in which one party directly enters into a customized agreement with a party to take delivery of a quantity of corn at a specified price at some future date is called A, a spot contract, B, futures contract, or C, forward contract. This is a good question because, again, it shows you the importance of just one word in the question being extremely important. So when I highlighted that in bold green, this says a contract in which one party directly enters into a customized agreement. As soon as you see that word customized, it means it's a forward contract. C is correct. In a forward contract, one party directly enters into an agreement with another party to deliver a commodity such as corn at a specified price at some future date. And that should really say enters into a customized agreement, okay? In the spot market, the contract is for immediate delivery of the commodity at the spot price, and a futures contract is a standardized agreement, whereas a forward contract is a customized agreement. So again, I could change this question very easily to change that bold, in the question here. If a contract in which one party directly enters into a standardized agreement, then the correct answer was B. So as I'm going through the learning ecosystem and I'm looking at the questions, I'm not only looking at the solution to this question, but I'm thinking how it could be changed and anticipating how they might ask it on the test. And by changing the word customized to standardized, the correct answer becomes B instead of C. Okay, so that's my process. And just another quick practice question. This shows you again how they're going to test, between differences and similarities. So this question is a key distinction between forward contracts and future contracts is that forward contracts A are only settled with cash, B have lower transaction costs, or C have no cash flows except at maturity. The correct answer is C. Forward contracts have no cash flows except at maturity, whereas future contracts are marked to market daily. Okay? Transaction costs for future contracts are lower because they're standardized than forward contracts, which are customized. So that should make sense. And forward contracts may be settled with cash or physical delivery of the underlying. We saw the example with a forward contract, an exchange of wheat. Okay, so that's the physical delivery of the underlying. So a quick exam tip here. When I'm looking at a question like this, I always read those last two questions. I want to make sure I don't get it backwards. So I'll read that. Forward contracts are only settled with cash? No, I make them into true or false questions. That's false. Okay, forward contracts can also be settled with physical delivery of the underlying. Forward contracts have lower transaction costs? No, that's a false. Forward contracts are customized agreements. That's going to be more expensive than a standard agreement. Forward contracts have no cash flows except at maturity. Yeah, that's a true. And so I'm looking for the true answer. So that's another quick little exam tip, multiple choice exam tip. Read it says here, read those last two words and read the sentence and decide whether it's true or whether it's false. And I'll actually even sometimes jot down on my paper, false, false, true. And I'm looking here for the true answer, because you need to be a little bit careful sometimes with the CFA Institute. They like to use most likely, which is looking for the true. But if they use least likely, then you're looking for the false. And that's why, by turning a multiple choice question into true or false, 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 true, I was looking for the true. But if it's least likely, you're looking for the false. And a lot of times, those are the questions that trip up candidates. And that's why it's very important to read the question very carefully and even sometimes underline the key words. Like here, I might underline forward contracts. I read it as a sentence. Forward contracts are settled with cash? False. Forward contracts have lower transaction. False. Forward contracts have no cash flows except at maturity? True. Okay, C must be right. That's the true that I'm looking for. If it's the least likely, I'm looking for the false. Learning outcome statement F is describe options and their uses, okay? So options give one party, the buyer, to the contract the right to extract an action from the other party, the seller, in the future. In an options contract, the buyer of the option has the right, but not the obligation, to buy or sell the underlying, okay? So a call option is the right, but not the obligation to buy, and a put option is the right, but not the obligation to sell, okay? And the buyer of an option contract has to pay a premium, and the seller of an options contract will receive that premium, okay? The buyer of the contract will exercise the right or option if conditions are favorable or if specified conditions are met. If the buyer decides not to exercise the option, it expires without any action by the seller. Options may trade in the over-the-counter market, but they trade predominantly on exchanges. So some of the key terms that we're going to see in this little section on options are the buyer, who has the right but not the obligation, the seller or writer, who has the obligation. So again, looking at a call option, the buyer has the right to buy, so the seller will have an obligation to sell. If we look at a put option, the buyer has the right to sell, so the seller of a put option will have the obligation to buy. Okay, so that's very important to understand. Also, when we look at options contracts, again, there can be various different types of underlying. One thing we need to be aware of is the contract size, the exercise price, which is also called the strike price. The expiration date is when the option expires, and the option premium, and that, as I mentioned, that's what the buyer pays for the option, and that's what the seller will receive for the option. So we're continuing here with option contracts and looking in a little bit more detail at the call option. With regards to a call option, the buyer of the option has the right, but not the obligation to buy the underlying at the fixed price, the exercise price. So I've written here, buy low, sell high. If I'm buying a call option, I've got the right, but not the obligation to buy the underlying. I always want to buy low and sell high, okay? So when we're looking at call options, we talk about the option being in the money, at the money, or out of the money. And so when what we need to compare is the market price of the underlying asset versus the exercise price for the option. And again, I like to use some theoretical examples, hypothetical examples, using ones, tens, hundreds, or thousands. In this case, let's put a few numbers on this, and I think you'll see that it's fairly easy to understand, okay? I always have to understand, if I buy the option, I've got the right. If I sell the option, I've got the obligation, okay? And if I'm buying a call that gives me the right to buy something, I want to buy low and sell high. So for example, if the exercise price of a stock, the right to buy the stock is at 100, and that gives me the right to buy when I buy a call. If the market price is at 110, which is above the exercise price, buy low, sell high, I'm going to buy at 100 and sell at 110. I've made a profit, okay? So that's fairly easy to understand. A call option gives me the right to buy low, sell high. If the market price is above the exercise price, the call option is in the money. When a call option is at the money, it means the market price equals the exercise price. Don't forget, we pay a premium to buy a call option. So if we looked at the break-even price for a call option, it would be the exercise price plus the premium that I've paid. Again, the call option is out of the money. It's not exercised if the market price is below the exercise price. So let's just keep that same $100 as my exercise price. That gives me the right to buy at 100. Why would I exercise my option giving me the right to buy at 100? If the market price was 95, I would simply buy the stock on the market. I would not exercise the option, okay? If we move to the put option, it's just the opposite, because the put option gives the buyer the option has the right but not the obligation to sell the underlying at the fixed price, the exercise price. So what I've written here is sell high, buy low. Buying a put option is similar to short selling. You want the underlying price to go down. You want to sell high and buy low, okay? So with regards to a put option, the option is in the money if the market price is below the exercise price. Again, at the money is the same. And it's for a put option, it's out of the money if the market price is above the exercise price. So a quick practice question to check our understanding. It's in the learning ecosystem, classified as an expert question. And the question is, which of the following options would be described as being in the money? A put option in which the underlying price is lower than the exercise price. B, a call option in which the underlying price is lower than the exercise price. Or C, a put option in which the underlying price is higher than the exercise price. Okay, this question is not that difficult. Again, it's English language test, in this case subject options, and at first it may seem a little bit confusing, but I'm going to give you some tips here. So it says here, which of the following options would be being described as in the money? So that's the first thing that you need to do. The question is going to ask you either in the money or it's going to be out of the money. So therefore, this question is being asked in the money. I'm looking only at this part of our grid, okay? And so remember, I'm always going to start with what is easiest for me to remember. And I know with a call option, it's in the money if the market price is greater than the exercise price, because if the exercise price is 100 and the market price is 110, I want to buy low and sell high, okay? So I'm going to be looking for a call option, the market price being above the exercise price. And I know for a put, it's just going to be exactly the opposite. So I'm going to write here a big call, and then here the put, I'm going to put market price below my exercise price, okay? That's for in the money. If it's out of the money, it's just going to be simply the opposite. So if you just start with understanding a call option being in the money, the put option is the opposite, okay? And also for a call option, when it's out of the money, it's just the opposite. So just start with understanding one, and I think it's easy to recreate the grid. Anyhow, it's looking for in the money, so it's going to be a call option with the market price greater than the exercise price, or for a put option, the market price being below the exercise price. So I'm reading the first one here, a put option in which the underlying price is lower than the exercise price. Underlying price, or write the word market price. And yes, that matches up with my grid, so A was correct, okay? Again, a put option is in the money when the underlying price is lower than the exercise price. The put buyer has the right to sell the underlying at the exercise price, which is higher than the current market price. So we want to sell high and buy low. When the price of the underlying is below the exercise price for the put is said to be out of in the money. If the price of the underlying is the same as the exercise price, the put is at the money. And if the exercise, if it's above the exercise price, the put is out of the money. But again, just start with a call option being in the money. You know that the put option is the opposite, and you know for out of the money, it's the opposite as well. And then it's easy to recreate your grid. So another quick practice question at the expert level. Consider a put option whereby the market price of the underlying stock is greater than the exercise price. At maturity, the profit for the holder of the put option is most likely A, equal to 0, B, less than 0, or C, greater than 0. Okay, this is a nice little tricky question because it has a little bit of a twist, but I just put in this second question because I would just want to show you through my process what I'm going to do on a test. You know, I've got my call and I've got my put, right? And I'm going to put in the money. So I'm always going to start with my call. I know when the market price is greater than the exercise price, the call is in the money, okay? So then I know for the put, it's going to be the exact opposite. I'm just going to change the sign. The market price is below the exercise price, and out of the money it's going to be equal. At the money is going to be equal. So I'm going to do out of the money, And I know for a call it's just going to be the opposite, so I'm just going to change the sign. The market price is below the exercise price, and here it has to be the opposite, so the market price has to be above the exercise price for the put. And so now I've recreated my quadrant. I'm going to go back and read the question more carefully and then try to line up the solution. So it says here we're dealing with a put option, so we're dealing with this column, and it says the market price of the underlying stock is greater than the exercise price. So I'm focusing here, and I know that it's out of the money. Okay, so when I buy an option and it's out of the money, I don't have any profit, and it's not going, I'm just going to let it expire. But there's just one little trick here. When it's talking about the profit, some people might have said it's equal to 0, but no, don't forget, when I buy an option, if I'm a holder, so it says here, the holder of the put option is the buyer, you've had to pay a premium. So because you've paid that premium, yes, the option is out of the money, but your profit is less than 0 because you had to pay the premium. Okay, so it's very easy. Number one, build your quadrant, go back to the question, line up with, it's a call or a put, match up the words, and then choose the right selection. So the key is to be able to not do everything in your head, but write out the quadrant when you're doing these type of questions. For a call to make money, buy low, sell high, and for a put to make money, sell high, buy low. Okay, this slide is looking at the effects of an increase in a factor on the values of a call option and a put option. So let's start with the easy bits first. You can see that if we increase the time to expiration, it's going to increase the call option premium and the put option premium. And the easy explanation for that is that as I increase the time to expiration, it increases the likelihood or probability that the option can be exercised, and that's going to have a positive impact on the call option, both the call option and put option premium. Similarly, with the underlying volatility, we studied volatility and quantitative concepts. As I increase an underlying volatility, it's going to increase again the likelihood or probability that the option is going to be exercised. So that's going to increase both the call option and the put option premiums. Okay, time to expiration, underlying volatility, same effect on both call option and put option premiums. But we get, when we move here to underlying price and exercise price, it's going to have the opposite effect between call options and put options. Okay, again, starting with the call options because I think it's a little bit easier to understand. Call option gives me the right but not the obligation to buy, and I like to sometimes use an example of a stock, and I use a hypothetical price. So let's just say the exercise price equals $100. Okay, as the underlying price increases, I've got the right but not the obligation to buy low, sell high. So as the underlying price increases, it's going to increase my call option premium, and of course, therefore, the put option has to be the opposite. It's going to be decrease. Okay. As I increase the exercise price, though, so that exercise price is going from 100 to 110, buy low, sell high. I'm increasing the exercise price. I'm going to decrease my call option premium, and the put option therefore has to be the opposite again. So again, using my process, start with the call option, decipher that, and the put option is going to be the opposite with regards to the underlying price and exercise price. Now we're moving on to swap contracts. Learning outcome statement G is define swaps and their uses. Okay, so swaps are typically derivatives in which two parties exchange or swap cash flows or other financial instruments over multiple periods, months or years, for mutual benefit, usually to manage risk. These swaps, like forwards and futures, are forward commitments or bilateral contracts because both parties have a commitment in the future. Similar to forwards and futures, as one side of the swap contract gains, the other side loses by the same amount, so it's a zero-sum game. Swaps in which two parties exchange cash flows include interest rate and currency swaps. An interest rate swap, the most common type, allows companies to swap their interest rate obligations, usually a fixed rate for a floating rate, to manage interest rate risk. A currency swap enables borrowers to exchange debt service obligations denominated in one currency for equivalent debt service obligations denominated in another currency. Finally, credit default swaps are not truly swaps. One party buys a credit default swap to protect itself against the loss of value in a debt security or index of debt securities. The loss of value is primarily the result of a change in credit risk. The seller is providing protection to the buyer against declines in value of the underlying. Okay? So the use of swaps has grown because they allow investors to manage many kinds of risks, including interest rate risk, currency risk, and credit default risk. In addition, investors can use swaps to reduce borrowing and transaction costs, overcome currency exchange barriers, and manage exposure to underlying assets. So a quick practice question from the learning ecosystem. It's at the difficult level. The seller of a credit default swap, A, receives protection from the buyer in the event of a default. B, agrees to protect the buyer from losses in the event of a default. Or C, exchanges principal with the counterparty when the swap is initiated. Okay, that question is not too difficult, but again, it's the importance of really a laser-like focus on reading the questions and picking up on the key words. In this case, the keyword is the seller. The seller of a credit default swap agrees to protect the buyer from losses in the event of the default. Because remember from the previous slide, with a credit default swap, that one party buys protection, so the buyer is buying protection. The buyer receives protection from the seller. Okay. So again, you can change a question, forecast something on the test, change the question that the buyer of a credit default swap would be receiving protection from the seller. Okay, and that's one of the techniques that I use is I try to create new questions from questions that I'm doing to anticipate how it could be changed, because obviously on the test they're not going to be the exact same as in the learning ecosystem. Okay, so this says difficult, but I don't think it's too bad. Remember, the buyer of a credit default swap is buying protection. The seller is agreeing to protect the buyer from losses in the event of a default. Okay, this is the last slide of content for this video, and then we're just going to finish with two quick practice questions from the learning ecosystem to check our understandings. Anyhow, the final bit of content topic here is with regards to currency swaps. And an example of a currency swap, company C, a U.S. firm, wants to do business in Europe. At the same time, company D, a European firm, wants to do business in the United States. The U.S. firm needs euros and the European firm needs dollars. So the companies enter into a 5-year currency swap for $50 million, assuming that the exchange rate is $1.25 per euro. On this basis, company C pays company D $50 million and company D pays 40 million euros to company C. Now, each company has funds denominated in the other currency, which is the reason for the swap. The two companies then exchange monthly, quarterly, or annual interest payments. That's the very important key point, that with regards to a currency swap, the two companies exchange monthly, quarterly, or annual interest payments. Finally, at the end of the 5-year swap, the parties re-exchange the original principal amounts and the contract ends. Quick question from the learning ecosystem at the difficult level. The parties in a currency swap exchange A, interest payments only, B, principal payments only, or C, both principal and interest payments. Really not too difficult. The parties in a currency swap exchange both principal and interest payments. C is correct. In a currency swap, there's an exchange of principal at the beginning and end of the swap contract. There is also an exchange of interest payments in different currencies during the life of the swap. So one last quick practice question from the learning ecosystem, and I put this one in just to show you the importance that, it really is an English language test, subject derivatives in this case, okay? So the question is, in contrast to forward contracts, option contracts are A, bilateral contracts, C, unilateral contracts, or C, multilateral contracts. The correct answer is B. Option contracts are unilateral contracts. Option contracts are unilateral contracts because only one party to the contract has a future commitment. Remember, the buyer of an option has the right, but not the obligation, so it's considered to be a unilateral contract. Forward contracts and futures are bilateral contracts because both parties have a commitment to fulfill the contract provisions, okay? And also want to show you that, questions on the test are from one or more learning outcome statements. So you could see that this question was based on the learning outcome statement, understanding forwards and futures, and also understanding options and their uses. And in this case, you're comparing and contrasting forwards to the options. So that's just one of the things you have to realize is that tests, exam question tests are based on one or more learning outcome statement, okay? And with that, that's the end of the content for this topic. And that is the conclusion for this video on Module 4 Investment Instruments, Chapter 11 Derivatives for the CFA Institute Investment Foundations program. Thank you.